Okay, welcome everybody. Today we've got a great panel. It's Evolving Hosting Mining. My name is Ben Gagnon. I'm the Chief Mining Officer at Bitfarms, publicly traded Bitcoin mining company on NASDAQ and the TSX. I'll be your moderator today. And I'd like to welcome to the stage Jason Les, CEO of Riot Platforms. And also like to welcome to the stage Niek Beudeker, Managing Director at Northern Data. Yeah. All right. Well, so we are going to talk about some hosting today. And hosting is a big part of the industry. It's been a big part of the industry basically since mining at scale was a thing. And it's really changed a lot over the last 10 years or so since mining became a really big part of the industry. And so first I want to start off, maybe, both these companies have done mining, both these companies have hosting. How has hosting evolved over the last 18, 24 months or so, especially with regards to the China mining ban and the migration of hash rate outside of China and into the West?
Sure, I'll start. So after the Chinese mining ban in 2021, obviously there was a huge demand for hosting in North America, and particularly in Texas. So our operations are all focused in Texas, in Rockdale, Texas, and soon Corsicana, Texas. And that was a jurisdiction getting a lot of attention at the time, still does. So there was lots of Chinese miners looking to come to Texas for mining. So for us, I think the first kind of evolution of mining that was taking place was a reset of expectations on cost. For a number of reasons, miners in China, I think, were used to a lot lower fixed cost for hosting. And coming to the United States, there was a bit of a different expectation, maybe higher labor costs, higher cost to build. Maybe the power in China was significantly cheaper than what is being procured in the United States. But for whatever reason, there was at first a reset of expectations. People showing up, yeah, we'd like 100 megawatts at 4 cents fixed. Well, sorry, that's not how we do things around here. But I think now since then, there's been an evolution over the kind of different markets. Something I've always noticed is during bear markets, everyone wants profit share. During bear markets, everyone's profit share. During bull markets, everyone's looking for fixed rates. So somewhat, I think, short time preference that people are looking at when they're trying to set up their contracts, not always knowing what the different market cycles are going to bring. So I think today we are at a mix of profit share and fixed rate deals that are out there. But I think one of the most interesting things that has been a part of the evolution is how power has been playing into hosting agreements now. Particularly in the United States or in markets like ERCOT, there's demand response revenue, there's all types of ancillary services, and there's this whole new component of how is that money being split up, who gets what's the appropriate time of curtailment, all of that. So that is a whole new evolution to hosting agreements that I see happening now, and I think the industry is still, as a whole, still figuring it out. I don't think we're at a standard of hosting yet.
Yeah, for sure. Niek, do you have any comments on that?
Yeah, I think it's well said, well observations. I mean, the market has been crazy in the last 3 years, right? It basically started with the whole migration, and we've seen the same thing. I mean, obviously, hash rate dropped significantly, meaning that it was very profitable for the miners that were already running. Now, at Northern Data, we are also longer in the game, so that was a pretty profitable period for us as well. And then the whole market started developing. You saw all these requests coming in, like we got emails every day about, can I put 10, 20, 50 megawatts of hosting with you? And we're like, well, sorry, we're putting our own hardware in because it's so interesting. But the whole hosting, I think, especially on the energy point, I think that's something that I see as well. But I would like to make a distinction between what kind of customers we're dealing with, because especially at the enterprise level, let's say the larger scales miner, 25, 50, 100 megawatts of capacity or more, they do demand to have much more control over their power. And it's not just fixed, because actually the higher the fixed costs are, the more risk you have as a business in a downturn. And that's something that we see definitely as a trend, as a business as well. that we want to take more control of our power, to be able to tap into these ancillary services.
Yeah, I think we have an interesting dynamic here where the host and the miners often have very, very competing incentives. And as Jason was talking about, in a bull market, everybody wants a fixed rate because they want all that upside. But in a bear market, obviously, they want that cost reduction. So they're wanting the best of both worlds. I guess the real question here is, as at Bitfarms, we're a developer operator of our own Bitcoin mining infrastructure. We don't have any hosting right now, but we have done in the past. When we look at hosting, we look at it as a strategic opportunity to leverage our core competencies in building and operating infrastructure. How do you guys look at hosting? Do you look at it as a strategic advantage, as something that you have as a company? Do you look at it transactional? Do you look at it as a strategic relationship with a specific partner? And then on top of that, how do you align incentives properly for both sides so that you can have a meaningful and sustainable relationship that can, survive both the ups and downs of Bitcoin mining economics?
Sure, I'll start. So I think we think about hosting similar to you as a tool to leverage our core competencies. When you're building a mining operation, the biggest cost is going to be the ASICs. So we can build infrastructure. We've demonstrated a strong capability and efficiency at building high-quality infrastructure quickly, and we can accomplish that, but the bigger expense is there than throwing in ASICs. So for us, it's kind of it can be a tool. Now, first, to be clear, we haven't expanded our hosting business since we acquired Winston US in 2021. We just have these existing agreements there, but we think about hosting as a tool that can monetize the capacity. If the cost of capital is high, the financing is not available to buy ASICs to put in there. So we're still leveraging our expertise. We're building infrastructure, benefiting from economies of scale, but just not making that extra huge expense on buying the ASICs and bringing someone else's in there. Now, the question that you posed, Ben, is the question, how do you align incentives? Everyone wants to win. The customer is looking for a payback. They're looking on a return on investment they made for their ASICs. So they need the best deal possible. And since they're already not vertically integrated and relying on a host, they're already at a slight disadvantage on the cost curve because they're paying that incremental cost. So, well, we as a host, we're not doing this for fun. We're trying to make a lot of money here. However, we need our customer to succeed. If we have an amazing deal and our customer is going out of business, then let's say we have a deal let's say we get a great deal, 9 cents a kilowatt hour hosting someone. Okay, that's great for us. And then a market like this one, or it's gone a little better recently, but let's say the last 12 months comes around, now that customer has to shut down, they're out of business. Well, now we're getting 9 cents a kilowatt hour on 0 kilowatt hours. So that's not a good business. So I don't know exactly what the answer is to that yet. I think that's something we're spending time on. I think that's something the industry as a whole is trying to figure out. How do you align incentives so the customer can succeed and the host can succeed? And I think it's ultimately kind of both sides doing a little give and take to get to ideal alignment.
Yeah, and Niek, you guys come at it, from multiple perspectives. You have had hosting, you've built and operated hosting. How do you look at it, strategically going forward, especially as it relates to the halving and, the economic risks that are associated with, the block reward being cut in half in roughly a year?
Mm-hmm. Yeah, so tapping into your first point about what we did as Northern Data, we are essentially an infrastructure company. So we build and operate infrastructure. And so that has been our core, and that's what we do. So we do this for both mining as well as for cloud, cloud cluster, as well as an ASIC cluster. And so in the beginning, we hosted customers when the demand was so great. After the migration, we started building infrastructure for our customers that had access to power, very cheap power. And so we hosted them, and we figured out that during the years thereafter, we got access to the hardware at very attractive prices, and we're like, okay, is this something sustainable that we're in this hosting business, but we have all this access to hardware? Why wouldn't we put it in ourselves? And so we kind of switched our strategy more towards still building infrastructure, but also doing mining. And so I had the mining department, meaning that my job is to basically place the ASICs as efficiently as possible. And it can be either within our business, with our own infrastructure, or outside. That being said, that is an interesting dynamic which we often see across the industry, especially when, well, let's say you are a host and you have a fixed agreement, and the miner tips over or the miner is unprofitable. Effectively, as a host, you then become a miner, because there were a lot of clauses in the agreements in the past where you basically get a lien on the assets, you got security over the assets to make sure that you can still pay for the power. And so what I've seen in the industry, and it's kind of a trend, is they start off as a host, and then a miner defaults, and then basically become a miner. Like if you talk about the larger other miners like Core Scientific, they did a little bit the same thing. They built out the infrastructure, they got customers on kind of short-term agreements, or the customers defaulted and they kind of expanded their own ASIC business as well. And that's a trend that's interesting, because you basically start off as a host, which is a completely different business model than a miner, and then you become a miner. And I think that is kind of the preparation for one of the biggest trends that I'm seeing in this industry, is this vertical integration of everything, and the power, and the host, and the miner, because effectively then you strip out margin, and you also strip out the complexities of trying to find a kind of an arrangement that works for both parties. Right, that not the host default or the miner default, it's all one. And I think this is something where mining generally as an industry is headed, this vertical integration.
Well, one other thing I was thinking about that I wanted to mention, I'm thinking about hosting. I talked about it as a way to utilize capacity, infrastructure capacity, that we wouldn't invest in putting ASICs in. Another thing we think about is having business lines that are valued differently, more appropriately by the market. So you look at data center companies, they have very high multiples. So I think as host, one of the ideal outcomes is getting your hosting business valued like a data center business. Now, that's tough because the data center businesses are valued this way because they have these real strong blue chip customers. The agreements are really long term. There's no profit shares with Microsoft. It's just there's some fixed agreement there. So when we think about hosting agreements, we want to aim to have them valued differently. So, while we as a company are very bullish on Bitcoin, and I think would be interested in a profit share agreement, the market would likely just value that profit share as just another self-mining operation with the risks that go along with that. So having a fixed rate agreement that can be valued like a data center is attractive, but then you need something very long term. You're not going to get a ton of value, a ton of credit attributed to a 1-year agreement. So now you're talking, okay, we need 5 years, or I think going longer than that in Bitcoin mining would be a little tough. You have a 5-year agreement. Now, how do you think about the economics over that long of a term? It's just really challenging. So no answer there, just making the comment.
Well, thank you for making that comment. It's funny we talk about this when the incentives and the profit split, because when Bitcoin mining was predominantly in China, profit splits were like non-existent. You didn't really hear about profit splits before the China mining ban, and mining migrated out of the West. They may have, people may have been doing them, but they certainly weren't common. They weren't the standard. They weren't the norm. In China, it was more about fixed rate. Hey, I can develop this power. It's going to cost me 3 cents. I'm going to flip it for 4.5, 5 cents, and that's going to be my business. When the mining migration shifted, the China mining ban just resulted in such tremendous mining economics. And in the West, when mining starts coming here, it's done by that entrepreneurial, American spirit. Those are people who like upside. They want to take the risk. They want to speculate, and that's profit split kind of came out there. But it's a natural evolution to the space. And I think if you look historically at what a lot of the largest miners have done, if they try to balance out their hosting with their mining operations in order to reduce risks, in order to have that stable cash flow to offset any sort of a downturn. And so I think it is a good part of the business, whether you start on the hosting side or you start on the mining side. I think there's a natural incentive to keep moving towards the middle and have some sort of a hybrid approach. You think about your strategies for deploying capital. Like how do you look at whether you want to deploy more infrastructure or more miners into hosting? Like, how do you think about that capital decision and where you're making your investment and what the associated risk profiles are?
Yeah, so I think that's a very good question. I think mining, in essence, is so much about power, first of all, but the other component which is critical to developing and building a business is the capital side. And we've been through a period where capital was extremely cheap, right? So in the public markets, you can get capital almost free. The equity markets were booming, and there was a lot of capital that you could spend. And it also meant that a lot of companies basically took decisions quite quickly in terms of where they spent their money on. And so that whole field has changed now in the last year when the Fed starts raising their rates. It becomes more and more expensive to get capital, which means that it also becomes more important to figure out where do I spend my capital across my business lines, or on ASICs, or on hosting. I think in the end, having a hosting, let's say, having infrastructure in a good location with a good power rate, that's where most of the value lies, right? So whether you put in your own ASIC or a customer's ASIC, that doesn't really matter that much because both require capital, and for both, either one gets a return. But in essence, all miners need to be hosted somewhere, and the better you can do that, the cheaper and with the better power, the more value you basically generate. And so we look at that as the basis for us is to continue to build infrastructure, to have that layer of value, and whenever the time is right and the prices are right, we spend our money also on the ASICs to be able to kind of eat from both worlds whenever it's kind of more a tactical way of approaching it. And that's something we've done in the past, and it actually yielded very well results. And so my challenge in my business is to kind of determine what are opportunities across this kind of capital cycle, and where do we spend our money on at what time. And that is a challenge. But I think that if you're consistent in your approach, if you stick to the buckets of value that makes sense, then I think you will generate long-term value as a company as a whole.
Perfect.
Yeah, I think the one word that comes to mind when I think about the value of building infrastructure is having optionality. We build this infrastructure, and we have optionality of what to do with it. We can fill it with self-mining. We can fill it with hosting. Now, typically, you want to make that decision pretty quick, but you don't always have to right away. And that allows you to make, like Niek was saying, strategic decisions off different market cycles. For us also, we have this incredible team that is now experienced and, for a young industry, about as seasoned as you can get for building infrastructure, air-cooled infrastructure, immersion infrastructure. And that is an engine that we want to keep going. We can't build this up, build a site, send everyone home, and downsize ton, and then be like, okay, in a year we're building again, and then we get everyone back. Like, you cannot run a business like that. So we view our team as this incredibly talented, powerful engine that can keep churning out new infrastructure, building this optionality for us. So it's important for us that we keep that going, that we're really always in a state of building, and then figuring out how we're going to monetize that infrastructure, based on how the market plays out. I think we've demonstrated our preference is always self-mining. We're a Bitcoin company. We believe in Bitcoin. We want the most upside there as possible. But like I was talking about earlier, when the cost of capital is high or when the financing's not there, then we can lean in hosting. But always trying to keep that engine running, always trying to maintain optionality.
Yeah,
if I may jump in on this point as well. And so you mentioned optionality, and one of the things one of the trends I'm seeing in the industry now is that there are also different types of infrastructure start arising. So you have immersion, you have air-cooled, and you have liquid-cooled infrastructure, basically providing hosting for miners. How do you view that making those decisions for infrastructure, because you're actually creating like differentiation of type of infrastructure, and you don't know whether a miner in the future or yourself prefer either one of those technologies. How do you guys look at that, for example?
Yeah, that's a good point. When you are for even more detail than that, when you're building infrastructure, there's some degree of the type of hardware you're kind of committing to. You're building out with 4,000 watt plugs or whatever size plugs, and if the 5,000 watt machine comes along, well, then it's not fitting in there. So you're at different levels. You're making commitments on the type of hardware that you're working on. I think at Riot, where we operate in Texas, we believe immersion is the way forward. So all of our future deployments, what we're building at our new site in Corsicana, our first phase of 400 megawatts is all immersion. And I think that's going to continue for the all full gigawatt. We've learned so much at the first 200 megawatts we built at our Rockdale site, incredibly valuable lessons along the way. And we are iterating and improving as we always have been and building this out. So I think the point you're making is right. You can't necessarily build a whole array of things and tell someone, here's your menu. You want air cooling? Do you want hydro cooling? Do you want immersion? There's some level of commitment you're making. And for us, because of the operational efficiencies that we see, the capital efficiencies that we see with immersion, that's the bet we're making going forward.
Yeah, I think the optionality is really key here, and the site design and the site cooling design is really location dependent, right? So what works in Quebec is not going to work well in Texas. What works well in Texas, may or may not work in Paraguay or Argentina or Germany or elsewhere. So those choices I think are mostly location dependent. Right, you are trying to build the right site for the right location, but from a developer operator perspective, that optionality becomes really big because the opportunity cost for having megawatts unmonetized versus the opportunity cost of having miners unmonetized is very large. Right, the risk profile associated with having infrastructure built and not running, for a certain amount of time, versus the risk profile of purchasing miners and having them sitting on the floor for unknown amounts of time, very, very different. And so, I think it's about balancing that flexibility for the operator, because when you're building infrastructure, you could be looking 12, 18, 24 months out, depending on the scale of that infrastructure, especially if you're building subs. And when you're buying miners, you don't want to take a 24-month lead time risk.
Yeah.
And so there's a give and take there when it comes to the opportunity cost and the flexibility that both of the different options give you. But when you're thinking about that, how do you actually take into consideration? Okay, we've got these different opportunities here. Say you got a 500 megawatt site. How do you take on that 500 megawatt site at the time? It's highly dependent on the underlying mining economics, your capital position, your cost of capital, the availability of equipment, all these different things. So it becomes a real game of trying to chase, a tail. Really, you kind of just have to, like you said, you have to make a choice. You have to pick it, and you got to move forward. And I think with, immersion is a very promising technology, but air-cooled still completely dominates the market, and it does so because it's just cheap. Immersion, you're getting a better high quality setup, but it comes at a cost. Like everything is a trade-off between cost and time and operational expense. With regard to that, I think that's actually kind of an interesting point there about the immersion, because I don't see a whole lot of immersion specific hosting. There definitely are some players out there, but I haven't seen a whole lot of immersion-specific hosting. When you're looking at different opportunities, mostly are you looking at the hardware side? Are you looking at the operator side? Because I think the biggest challenge with hosting is counterparty risk, and this is true on both sides of the equation, right? If you are a developer operator of that site and you bring in a customer or you build out a site with massive investment for a customer that doesn't come through with machines.
That's awful, yeah.
What do you do, right? Maybe you can find somebody else, but maybe the market goes against you. Also on the other side, if you're somebody who's making massive investment into machines and you're expecting them to be deployed, and the counterparty doesn't deliver, and they're taking months and months and months, and that's all missed revenue and profitability. How do you manage counterparty risk in hosting? Because this is a real challenge.
Yeah, I think that's a very good question. And I think that's one of the hardest things, because this industry is so whether you're a miner or a hoster, this is so interlinked. Like everybody's craving to hash, basically, because that's what's making the return. And so it's challenging to, for example, get the right collateral from the other side, right? So you can sign contracts, but if there's no miner running, there's no income. Like there's nothing to kind of you can sue other people, you can sue the other, but that probably doesn't bring you very far, because if it doesn't have the hardware, or if the infrastructure has massive issues, like there's not much to get. And so it's quite challenging to solve this problem, and we look at it always as partnerships, in a way where, okay, we'll accept a bit delay on each side, so we build in protections where we say, okay, hey, the miners are delayed for 30 or 60 days, then that's acceptable. If the infrastructure is delayed for X days, acceptable. And if you go beyond that, those are reasons to kind of terminate and separate ways, because either one of the parties is not delivering on what they promised. However, those delays are extremely costly. And so how I look at it from my business is I try to put my eggs in multiple baskets. So I tend to oversubscribe, because you know that there are always delays. Like, everybody overpromised to build an infrastructure with the millions of megawatts or the gigawatts that everybody promised to build, and then there was a complete squeeze on procurement and worldwide shipments. And so that's extremely hard to kind of prepare for that. And so I look to oversubscribe a bit, because I think on the hardware side it's easier to find hardware last moment than hosting.
Yes.
And so that tends me to kind of weigh a little bit more on oversubscribing hardware, because we'll find the hardware at the right price.
Niek, I think you make a lot of good points, and it kind of brings up another challenge that I see in this market is, so we're talking about all the uncertainties. No one wants to take the risk on the uncertainties. Yeah. There's uncertainties of when ASICs will be manufactured and delivered, or if financing will be completed to complete those orders. There's uncertainty when you're building infrastructure and you have 100,001 parts that are coming in from all over the place, especially like you talked about the last year when there's all these supply chain constraints, that throws timelines all over the place. So what I've kind of seen because of that, what we've seen is the hosting customer side, they don't want to make a commitment until closer to turn on. So they've seen what's happened, and they're looking to make a commitment when they're more certain that infrastructure is going to be ready. So from our perspective, what happens is, well, I'll use a specific example. When we closed the Windstone acquisition in 2021, we immediately started a 400 megawatt expansion project. And initially our thinking was, okay, we'll maybe use half of this capacity for hosting. So we go out and tell people, this will be ready, and depending on the building, 12 to 18 months, we're looking to sell hosting. Everyone's like, no one wants to sign hosting that far. Even in 2021, when there was such a constraint on infrastructure, people didn't want to make a commitment 12 months out. They wanted the answer right then. They were looking for that perfect solution. Then 12 months go by, and then the hosting customer's like, okay, we need hosting. And we say, well, if we would have signed the deal a year ago, then I'd have something for you. But since you didn't, well, we just bought more miners ourselves and filled it with that capacity. So there's like a reset of everyone wants it perfect in a field of so much uncertainty and variability. And I'm not sure. One side has to ultimately kind of give on expectations. I think, like you said, having different outs in an agreement if different expectations aren't met. I think having different security commitments to protect both sides is a good idea. But I think it's a partnership-driven approach, and I think it's one that takes time to build and not something that you can throw in, in the last month when we say, okay, doors open, infrastructure's here. It's something that's ideally built, way ahead of time, so both parties can plan appropriately and set up the protections they both need.
Yeah. To add to this, I think that's one of the things that we should work on as an industry together, is to make our industry more mature. Because the things you now just described is like everybody in this industry wants to make money quick and looks at the short term instead of the long term, right? So, and it is about partnerships. It is about trusting the other side. Because otherwise, you're going to be switching back and forth all the time, and with all the risks that come with that. And I think it's time for our industry to mature and to kind of go into proper agreements with one another, and not being like preparing for the long term, and not just for the short, quickest way to get hashing. I mean, that's in essence is driven by obviously our capitalist society, but that for your shareholders, if you're public. But that's something that I think we should work on as an industry, to kind of mature contracts, not go for the quickest win, also build proper infrastructure, especially with the migration from China, you saw that people were like ramping up facilities. They didn't follow protocol. They were just, okay, if we can build this as quick as possible, then that's good. But that's actually very short-sighted. And that's something that I think we should try to change that image in the industry by doing it right, by building proper infrastructure and going into partnerships with one another and trusting each other.
And I don't mean to step out of my role here and start asking questions, but Ben, I'm specifically curious about you since you have the experience mining in China that we don't have. Today we're talking about Riot and Northern Data. We both have self-mining. We both have hosting operations. In China, my understanding when mining was more large scale there, it was a bit different. It was a bit like you were either one or the other. What are the differences that you've seen in like how that market looks like to how the hosting market in North America has kind of come out after that exodus?
Yeah, I mean, Chinese hosting mining was very, very big in mainland China, and it's a separation of capital and risk, which I think isn't the more natural place for the market to be. Effectively, you had two kinds of companies. You had the companies that were pure hosting, and these were the companies that were the largest hosting companies, like Shanghai YE. They were massive at scale back in 2016, 17, 18, 19, until the China mining ban, hundreds of megawatts. And then you have the companies that were self-miners who, wanted to offset a lot of their costs. And so there was a lot of miners in China who looked at hosting as a way to de-risk their mining operations. And there was a lot of hosting companies who looked at it as just flat fee. I'm selling electricity to somebody that would, there would be otherwise no demand for power at this remote hydro dam. And with China, and somewhere around 65% of the Politburo, which is the 255 members or so of the Chinese Communist Party that rule, 60% of them or so have hydroelectric engineering degrees. And so what kind of projects do you think get approved? It's hydroelectric engineering projects. And, this power gets built in all these different areas where there's just no manufacturing demand. Sichuan is not a manufacturing province. It all happens on the coast, right? And so they're generating power and they're building power, and there's lots of capital for power. There's just no demand. And so that's what enabled the mining migration. That's what enabled all of these hosting companies to pop up. And there's a big separation of risk there. And I think that's the natural evolution for miners to go. And as you're talking about for what's going to happen as the mining industry matures, I think the capital and the risk profiles associated with building the infrastructure and buying the miners are very different. And what is naturally going to occur is going to be people who are going to, sell off the risk associated with the future cash flows of Bitcoin mining so that they get a predictable return on their investment in the infrastructure. And that will enable them to scale up their infrastructure faster. It will enable them to get greater amounts of capital, greater amounts of capital at lower costs. And I think that will enable speculation to happen on the actual people who are buying the mining equipment. And that might happen either as a hosting arrangement. It might also happen through, derivative marketplace contracts where people are able to effectively, secure their revenues, right, in a similar way that they could with hosting, granted at higher capital costs. And that's kind of where we were. It's kind of where we're at right now, where I think we're going. How do you guys think this industry is going to mature over the next 5 years? The period going up into the halving and through the next halving epoch.
You mentioned the halving a couple of times, but we haven't touched upon that yet. I think it's interesting that you mentioned it because I think the maturity of the industry that halving is a given, right? So this is what we need to deal with. And so I think that the halving has less to do with the maturity of the industry. I think, in essence, what it's about is that we also create a better image of our industry by becoming more mature, not these radical, super quick deployments. That being said, I think the halving will have a great impact on how we deal with mining next year because there's a lot of uncertainty around that. And people investing or companies investing a lot of money into hardware or either infrastructure with that uncertainty added on top, right? So the economics are for a miner are pretty, people understand what they're getting into. And so adding this halving, adding the uncertainty around that, you don't know, okay, what power price is actually the cutoff point? What hardware efficiency is actually the cutoff point for us to be successful after the halving? in the end, in my view, it always comes down to the lowest cost of power and the most efficient machines. Like that combination is golden. You just don't always have that, right? So you have an older fleet, you need to upgrade parts of your fleet to kind of get to a level where it's acceptable, and you still make a profit. I think the halving is also a critical point where we're going to see, is this reduction in supply actually going to drive this price of Bitcoin up again? And will that continue every cycle? I think that's something that we have to deal with as miners. It's a race to the bottom, effectively. You need to be efficient on your capital, on your operations, on your power, to be able to be, let's call it the last man standing, if you will. And I think we're going to see quite a big shift around the halving in terms of ASIC prices, in terms of hardware coming onto the market, also in terms of sites becoming available that are not profitable anymore at that power rate. I mean, what's going to happen with that? Like, there's going to be empty sites of 100 megawatt. Maybe someone will put in a machine, but I don't know. I think, since this industry has scaled so much in the last couple of years, we're gonna also see the downside of such scale and bad decisions from the past. And I think the halving is going to be a critical moment for that to start observing that.
And if the price doesn't go up at the halving, we can just mint some more wizard JPEGs, and we'll make it up in transaction fees. No, just kidding. But I think especially in this business, any business, it's all about managing risk. So I think on both sides there can be value to diversifying your relationships a bit. So if you're on the side that's looking for hosting, you either have a very strong single partnership, or you can diversify your hosting relationships, across a bunch of partners in a smaller way. Now, then it just depends on your scale of how meaningful all those relationships are. If you have 100,000 ASICs you're looking that get hosted, then you're having a major 10,000 ASIC relationship, let's say at 10 different spaces, 10 different hosting sites, just using that as an example. And then I think about it kind of similar on the host side as well. Instead of making one big bet on one customer to fill all your capacity, it may be more prudent, especially through something like the halving, to have an array of customers, and then once again their size kind of is just in proportion to what your scale is. If you're building a gigawatt and you're looking for hosting customers, okay, a 100 megawatt customer is huge, but if you have 10 of those, your risk is spread out a little bit. But I think with this halving approaching, and everyone's seen what happened before. Every time we go through these cycles, the industry collectively gets a little bit smarter. There's history we could work back on. You mining in China in 2014, there wasn't a whole ton of history before that. You guys are blazing a path. Now people have seen what happened through these halvings and how tight it can really get. How tight 2019 really was for so many miners. How tough 2022 got for so many miners. And because of that, I hope that will lead both sides of the industry we're talking about here to give a little and be a little more prudent on how do we set up a structure that works through all sorts of market cycles, not have such a short time view, thinking about the long term and surviving all of these cycles together.
Yeah, I think that's the key here, is how do you align incentives for both parties? And I think we're starting to get that structured and figured out, and I do think the more separation of risk you have there, probably the better. But there's always going to be a desire for upside, and a desire for greater and greater returns. Nobody's really getting into this business for Bitcoin at 30K, right? You do not buy a Bitcoin miner because you hope that Bitcoin's going to go from 27 to 30, right? You buy a Bitcoin miner because you're expecting Bitcoin to go from 27 to 65 to 100 and 120, and the value that you're going to get out of that Bitcoin miner is a much higher leverage, or a much higher beta to Bitcoin, right? That's why you get into Bitcoin mining. You don't buy Bitcoin miners because you expect the price to go back to 16, right? And so aligning those different incentives, keeping some sort of upside, I think is really crucial for both sides there. When we think about that, and we kind of coming up here on time, maybe just some closing thoughts on, hosting. What are the general challenges, or just I guess any closing thoughts that you have on hosting? I think we've done a pretty good job covering things so far. Just wrap it up.
Yeah, I think what Jason just said, this industry is about risk management, right? So we have, if you think about all the risks that are in this industry, on the revenue side, on the power side, on the operational side, a hoster or a miner will do well if they manage their risks well. That's what I fundamentally believe. And it means that I think also on that front, we're going to see more and more ways of companies trying to protect themselves and manage those risks, either through derivative products, as you said, to try and lock in certain costs that you have, or let's lock in part of your revenue in dollars so that you can cover the cost that you have. Such derivatives products, I think, are going to be a great component of this industry maturing and managing that risk.
I would just lean into the point I made earlier. Is just the longer lead time on setting agreements in place. We want to enter into agreements. We want to form partnerships. We want to have visibility of how this capacity is going to be monetized as far out as possible. And I think our challenge is getting customers who are that forward-thinking as well and want to ink an agreement 12 months out, even 18 months out, if we can do that good, instead of 3 months out, hey, now we're ready to go. I think having an industry that's collectively more forward-thinking and less focused on just what the next 3 months looks like, I think sets both sides up for success. So I guess it's a bit of patience that we need to disseminate across the industry here.
Yeah, a little bit of patience is not something that the Bitcoin industry is really well known for. We just keep expecting it to move. And has anybody checked the price yet? I'm not sure. I haven't checked since I got on stage. Yeah,
it's mooning to 26.9.
There we go. I think the separation of risks is really important. I think longer and longer timelines, having those contracts in place is also going to help you on the capital side of things. Yeah. It's going to help you raise that capital at a lower cost in order to build out the scale. And I think all of those things are really, really crucial as we look at this industry rolling forward. I think there's tremendous opportunity in this space, especially when it comes to, these are my closing statements, especially when it comes to energy utilities and people who have marginal cost electricity or electricity they otherwise couldn't monetize. I'm looking forward to seeing a lot more hosting companies who are offering services for that marginal electricity, that can appeal to lower efficiency machines, that can appeal to older hardware, people who are open to larger amounts of curtailment in order to reduce their costs. Mm-hmm. Because I think what's really going to drive this industry forward is a move to increasingly lower cost, increasingly marginal cost electricity. And I would love to see that starting to get integrated into the energy infrastructure itself in order to just soak up this inefficiencies that the electricity market currently has. Yeah. And I think that's going to be a real driving force forward for institutional adoption.
Yeah, absolutely.
Yeah. Well said. Well, great. That was Evolved Hosted Mining. Thank you, everybody, for coming out. Give it up again for Jason and Niek.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.